take us back to your time here at HBS.
It's 25 years ago. I guess you forget a lot from 25 years ago, but you don't forget HBS. I remember in the very first class I had, I was amazed at global diversity. I mean, this is 25 years ago, and I was in a class with people from Korea and China and Africa and of course Europe and Japan, and so I was just amazed at the fact that they could attract these type of people from all over to sort of get an education all together in the same spot. Where I learned from their experiences, which were quite different than mine, having grown up here in the U.S.
And I always think about something, John, like those educational experiences like the one you had here, what stays with you or how it shaped kind of where you are 25 years later?
It's funny because, Harvard has a very specific way of doing things. They try to take all of their cases, and they're the case approach.
Right.
And everything is from the prism of a leader. Here I am, 26 years old. I'm not a leader, or at least I didn't think of myself as a leader. But those cases that you do over and over again every day in all these different environments, in all these different types of operations, strategy, globalization, all these things that we did, we had to become a leader every day in that classroom with 89 other classmates looking at you, challenging you. And that ability to be able to think on your feet, to be able to take a position, to have a voice, to have a point of view, to back it up with facts. I think those types of skills are incredibly important in the business world as a leader today for me, and it stayed with me for the entire time.
It's interesting you say that. We caught up yesterday with Tony James over at Blackstone, and the way he said it is, you got to learn to hold your own, And he was about your age when he came through as well. He came right out of undergrad, and so it's a maturing for sure. So let's talk a little bit about the world that we're living in right now, because it is an interesting one, to say the least. You're a global investor. You see all sorts of crosswinds, I would imagine. As you look around, a week that we hear from the Fed, we're looking ahead to the G20. How did geopolitics figure into your investment thesis right now?
Well, it's complicated. I mean, I think the level of disruption that might arise by virtue of the direction of different sovereign nations about what they intend to do to protect IP, the trade war, of course, is on everybody's minds. The element of the overall economic policies of what is going to happen with central banks. These were fairly stable over the 30-year career I've had in private equity, but they're pretty complicated today. And frankly, the valuations that we've seen haven't really incorporated some of that complication.
Why is that? Is it because there's a lot of money out there, John?
I think there's a ton of money and there's a lot of hope.
Yeah.
And I think generally, even back when I started in private equity in 1989, people talked about the fear of what was going to transpire, but it takes a while before that really to take hold and get reset in valuations. So it wasn't until 1991 where we really saw a recession. We really saw the downturn that it actually began to be realized in valuation. We saw it in pockets. China, first quarter of 2018. We saw it obviously in the fourth quarter last year as well in the U.S. And the rest of the global market. So it's out there.
Was that a valuation? Everybody's saying, okay, things are overdone, or was it a miscue by the Fed, or what was it?
I think there's a lot of short-term orientation to it, but there's enough fear out there. We're 10 years into the cycle, and certainly there are these disruptive factors that are out there. So I do think that people do have fear. So when they hear some things that are disruptive, I think valuations get reset pretty quickly.
And so with that backdrop, are you sitting around with your partners and saying, you know what, we may need to lean into selling things right now, or to continue to sell things? Where's the balance there?
Well, first of all, I believe that the valuations peaked, certainly in the private markets a couple of years ago, because the rates have come up to some degree, in the U.S. at least. And I do think that the industrial cycle, particularly in auto, for instance, in certain areas of industrials, has reset. And certainly with the public market reset and valuations for industrials, we're seeing that in the private markets as well. So we're seeing a great deal of industrial pipeline that's coming in to evaluate. But it's also tricky because there will be a cycle during our investment horizon. So you need to build that into your investment thesis.
Where are you guys finding opportunities? I know you just did, was it like a $900 million fund, a second fund for life sciences? And I know that's something you look at very closely.
Yeah, healthcare is a big area for us. We invest early stage, we invest late stage, we invest through our credit funds. And so healthcare has always been a big part of our strategy. But actually, healthcare itself in each of our verticals, we're going deeper and deeper. So life science is an example, where we want to be not just a biotech early stage investor, we want to be in the inflection capital business. So we did this strategic relationship with Pfizer, where we took their entire CNS platform, carved it out, put it into a new company, and now we're building a company with Pfizer that's going to be a leading CNS player. You don't see biotech venture capitalists do that. You don't see private equity traditionally do that. But because we're so deep in life sciences, we have those capabilities to do late-stage inflection capital for life sciences.
Of course, you have that depth of knowledge.
And scale of capital.
Yeah.
Both the capabilities to understand it, capabilities to build companies, and then capabilities to deploy large-scale capital behind that.
What are you avoiding right now?
Anything high-priced.
Well, where are you finding things most high-priced?
No, I think that we have been of the view that ever since the recovery, where a lot of money has gone into, stability kind of deals that are kind of low growth, deals that basically don't have discontinuity and change. They're actually pretty stable. A lot of people are going to those safe havens and paying up for that stability and leveraging it to very high levels, higher and higher every year. And so from that perspective, we think there's a real re-rating risk for stable assets that have been overpriced because of all the liquidity and because of all the credit support that they've gotten from central banks.
John Connaughton, great to be with you here at Harvard Business School.